Greetings, everyone. In this video, I will be discussing factors that drive price, what every strategy must include, and indicators you can use to understand these things on your charts. My name is Jeremy Dancer, and I am a Forex coach. I use my channel to help people use the law of attraction to help manifest their desires and become better traders. So if you want to join me and become part of my program, please click on the link above and check out other videos in my YouTube channel as well as my private group. And I would love to work with you. All right, so let's get into this. We're going to start with what every strategy must include. Here is a screenshot of what that looks like. And throughout this video, I'm going to be sharing other screenshots just like this, so that you guys can save them and add them to your documents. So one of the reasons why I am making this video is because I noticed that after my coaching sessions, I had many students come to me to want to kind of review what we discussed inside the coaching sessions. So I want to make sure that I am providing additional resources for you guys, so that you guys don't always have to meet with me. Most of these videos are designed to work with my coaching program, but they are still packed with tons of information. All right. So the first thing I want to get into is the volume aspect of trading. All right. So as you guys can see here, I have a volume profile set up. I also made a video on the volume profile. So if you want more information on that, I'm not going to go into too much depth in this video, because I made a video on it. But in short, you can see the volumes right here off to the side. And you can also see the point of control lines. The point of control lines is where 70% of the trading volume is taking place. So normally what you're going to see is that the algorithms and banks are usually going to push the prices to where you see these point of control lines, which makes them extremely useful in your trading. Right now, gold is at 26.48. So we can see the point of control area is around 26.87. So you can bet at some point the price is going to shoot up to this area, because this is an area where most traders feel comfortable buying and selling from. And banks and algorithms, they want to attract as many buyers and sellers. The problem with the price down here is that it's too low for traders to want to sell from, and it's too low for traders to want to buy from, because when you trade gold, you don't know if it's going to drop another 100 or 500 pips from here. So what ends up happening is many traders will just wait, and that's what the algorithms and banks don't want to do. So to make everybody happy, they will bring it to a level where everyone feels comfortable, and then that's when you see those massive trading volumes come back. So this is a very important indicator to have as part of your overall strategy. All right. The next thing that you're going to want to have is a indicator to help you identify who is in control. Okay, so now that we're inside my MetaTrader 4, I'm going to show you a few indicators that I teach newbies. So for those of you who have been in my coaching sessions and you guys forgot a few things, this is going to be a great video for you guys. All right, so the first indicator we have is the buyers versus sellers indicator. This indicator tells us the buyers and sellers in each candle. As an option, you can even use footprint charts on TradingView that can give you this information as well. It's a little bit more advanced and technical using footprint charts, but they are essentially telling you the exact same thing as this indicator. This indicator tells you the buyers and sellers in each time frame as well. So you don't have to scroll through the different time frames up here to see them. You can just see it right here. Knowing who is in control is very important because if buyers are in control, they can keep pushing the price up. If sellers are in control, they can keep pushing the price down. So just following who is in control can be very powerful in your trading. All right. Uh, I really love Bollinger Bands, especially for newbies. This teaches you price action. So in price action, you're looking for areas where the price is overbought and areas the price is oversold. So if we look at the Bollinger Bands, here's an example of where the price is oversold. When you see a spike outside that lower band, that's a sign that the price is oversold. Your confirmation that the price is going to be oversold is usually going to be with the CCI. So if a price is oversold, that means the momentum should go up. So when you look at the CCI, which measures momentum, you should see the CCI going up. MACD also tells you price action as well. So when you see candles below the red line, that's usually a sign the price is going to go down. When you see the bars outside the red line, that's a sign the price is overbought. So you can see here the price was overbought, and then this triggered a sell signal using the MACD. And then if we go back to our area here, we can see around this area that the price was oversold. So this is pretty consistent with this area right here, telling us the price is oversold. We see the bars outside are below the red line. That's telling us the price is oversold. And then we also see the CCI going up, which is telling us we're about to see some bullish momentum. This indicator right here is the ADX, the average directional movement index indicator. This is a very good indicator to use because it gives you signals. Every time the lines cross, triggers a sell signal or a buy signal. So one of the first things I do when you join my program is I give you this setup. And then I tell you how to customize the indicators so that it looks exactly like how you see mine. When you see this red line dropping down, that's a sign that the bearish momentum is losing steam. So this is also very consistent with the price being oversold. If the bearish momentum was strong, then we would see this red line continue going up. But since this red line goes down, that's a sign that, okay, you know what? We're about to start seeing some bullish momentum. Okay. Now, one of the things that I want to make sure people understand is when you are analyzing your currency pairs, don't analyze all the way down here. Okay. You guys want to stick to the current prices. So when you're going through my coaching program and you're doing the exercises inside there, some people will use, numbers from here, numbers from here, numbers from here, and that information is going to be way too old. All right. So you only want to look for the current price action. And when it comes to reading charts, you always read from right to left. Some people read from left to right, and then they have you know, bad information. So always make sure you start on the right side of your chart and then you go back and you look for, you know, recent signs of overbought and oversold conditions. And that way you'll have much more accurate information. All right. So this should be a nice refresher for a lot of you who have been inside my coaching sessions, and it should provide a lot of clarity. Uh, the next thing I wanted to talk about, and I'm going to go to my trading view for this. Okay, so now that we're inside my trading view, I want to show you guys how you can spot moves that algorithms are making. So the only way the price should move is if you have buyers or sellers that are driving the price. But now that we're during the holidays and the volumes are pretty low, that's because most of the big money is out of the market. So when most of the big money is out of the market, what you're seeing driving the price is going to be algorithms. This is why it is so important that you guys are using a volume profile during this time period. So if you see a massive move, like this one, for example, uh, there was not a lot of volume that triggered that made this move. So you can see here, I have um, a volume profile that tracks the sellers, and I also have a volume profile that tracks the buyers. So when buyers made this move, this was an algorithm that made this move. We don't see enough volume from buyers to make a move this big. And this happens because the algorithms are designed to make sure retail traders lose. So if you find yourself, you know, in sticky situations, it's because you're on the wrong side of things and you're doing what every other retail trader is doing. You have to understand enough about Forex to realize when there's going to be market manipulation. So when you see this area up here where you have the point of control areas, this is the area where you have 70% of the trading volume. So this is where you have the real buyers and the real sellers that are actually moving the market. So if you're trading away from these point of control lines, then you're most likely trading against algorithms. And I'm gonna be honest with you, you're not going to win against an algorithm. The only way you're going to win is if you beat other retail traders. So we have to learn Forex from the same standpoint that most retail traders are trading Forex and see what they're going to be doing. And sometimes we have to do the opposite of what retail traders are doing. And that's how you have a way to beat other traders, because there's going to be a lot of traders who see a bullish trend and they're going to be okay, you know what, I should definitely buy here. And then 90% of retail traders all start buying, and then what happens? The price makes a huge drop. That's because the algorithm will not allow the majority of retail traders trading in one direction win. There are just some things that just won't ever happen, and that's one of them. So, as long as you're part of the minority, then you're going to most likely always win. The only exception is when you are trading with banks and institutional traders. That is because they have the power to drive the price. Retail traders don't have the power to drive the price. So when you see big money in the markets, they can push the price down, and then they start closing positions, and then the prices become oversold or overbought. And they can make the market that way. It's very hard to do that, which is why they don't do it all the time. But you know, you can see those time periods. So when you know that the buyers are in control, it's usually because you have banks and institutional traders that are driving the price, and you want to be on, and you want to be trading with those guys. All right, you just don't want to be on the side that retail traders are on, and you can easily see that with the volume profile. So when you see these periods where you have small volumes, you can either stay out of the market or try and figure out, okay, you know what, I think a lot of people are going to be buying here, let me go ahead and start selling. And you should be able to do very well that way. So just as a recap here, we want to understand who is in control. If buyers are in control, meaning real buyers, not the algorithm, then we're going to follow the real buyers. When it comes to price action, you're looking for supply and demand, and you're looking for overbought and oversold areas. Overbought and oversold areas are pretty similar to supply and demand. All right, so this right here is the bottom of the candle. So when you see the bottom of the candle like this right here is a demand zone. All right. The supply zone is going to be the top of the candle. So it's going to be from here to here. All right. So when you see that there is more demand than there is supply, that is usually a sign that the price is going to go up. And this is how you read price action with candles. I'm not going to get too far into that in this video, but we already know when it comes to reading price action, especially for those of you who are new, you're going to use the Bollinger Bands for that at this point. We do have other things like the fair value gaps, the break of structure and change of character and all that kind of stuff that gets more advanced. But for right now, let's stick to the Bollinger Bands for those of you who are new. But for those of you who are ready to start reading candles, just know the bottom of the candle is demand, the top of the candle is supply, and it's also, areas where the price is overbought and oversold. All right. And then make sure you're tracking the volumes. I already gone over that. When it comes to momentum, we use the CCI for that. And don't forget to understand the different market conditions. So you have four different market conditions. You have trending conditions, number one. You have consolidation, number two. You have ranging conditions, number three. And then you have divergent conditions, number four. All right. And you're going to have different strategies in each of those types of market conditions. Thank you guys for watching this video. I know this is kind of long, but I wanted to make sure I was very thorough and I didn't leave anything out, especially as we get into the holidays. This is usually a good time for people to spend extra time learning new skills. So I wanted to make sure you guys had enough to work with that would be helpful for you. All right. Please let me know if you have any questions in the comments. Send me an email, join my group, and let's get ready for 2025. And thank you for all being here. Thank you for joining my program. This is really a blessing. I love what I do, and I appreciate all of you. All right, you guys, take care and have a good day.